The answer is order. Not the stock you pick, not the crypto you gamble on, not how well you time the market. Order. According to a 2023 Bankrate survey, 73% of Americans who actively invest still feel financially insecure. They're checking their portfolios, they're contributing to their 401ks, they're doing what every financial influencer tells them to do. And yet, they are one missed paycheck away from panic. Here's what nobody wants to say out loud. The problem is never what they're investing in. It's the sequence. They're building the penthouse before the foundation. They're choosing paint colors while the basement floods. And the financial industry loves it. Because every wrong step in your sequence generates a fee for somebody else.
My name is Guru, and for decades I've studied the patterns that actually build wealth versus the ones that just create a convincing illusion of progress. Today, I'm walking you through the 8-layer investment blueprint, a complete sequence where each layer must be finished before you touch the next one. Follow this order and you'll build more wealth than 90% of people will ever accumulate. Ignore this order and you might work just as hard and end up with a fraction. Now, I need to warn you. Some of this will contradict what you've heard from much bigger voices in this space. But the math doesn't care about popularity.
Before we get into the layers, I want to tell you about two families. Both earn $95,000 a year. Both started investing at 28. Both are now 45. Same income, same timeline, same city. Family A followed the exciting path. They opened a brokerage account immediately, bought individual stocks, dabbled in crypto during the 2021 hype, and contributed a little to their 401k whenever they remembered. They had some great years. In 2020, their portfolio jumped 40%, and they felt like geniuses. They told their friends about it at dinner parties. Family B did something very different. For the first 2 years, they didn't invest a single dollar in the stock market, not 1 cent. Instead, they built a 6-month emergency fund and then systematically destroyed $22,000 in credit card debt. Only after both of those were complete did they start investing. And when they did invest, they did it automatically, consistently, and in the right accounts. Fast forward 17 years.
Family A has a portfolio worth about $180,000. On the surface, that sounds decent. But they also have $15,000 in remaining credit card debt. They have $0 in emergency savings. And back in 2022, they had to liquidate $30,000 from their portfolio during a medical emergency, selling at a 32% loss because they needed the cash immediately. Their real net worth after debts and losses is closer to $100,000. Family B has a portfolio worth $340,000, zero consumer debt, and a fully funded emergency account they haven't had to touch in 3 years. Same income, same years investing, more than double the actual wealth. The only variable that changed was the order. That's what this video is about. The sequence that separates families who build real, lasting wealth from families who just feel busy with their money.
So, why do smart people consistently get the order wrong? 3 reasons. The first is that the financial industry profits when you skip steps. Every stock trade, every crypto purchase, every actively managed fund with a 1.5% expense ratio generates revenue for someone. But nobody in the financial industry makes a single dollar when you pay off your credit card. Nobody earns a commission when you move money into a high-yield savings account. So the advice you hear is naturally skewed toward the steps that generate fees. The second reason is psychological. Investing feels productive. You open an app, you see green numbers going up. You feel like you're building something. Paying off debt feels like losing money. You're watching your bank account shrink instead of growing. But here's the math most people never do. Paying off a credit card charging you 22% interest gives you a guaranteed 22% return on every dollar. Warren Buffett's long-term average is about 10%.
Your credit card payoff is outperforming the greatest investor who ever lived. The third reason is social media. We scroll through our feeds and see 22-year-olds posting six-figure portfolios, and we feel behind. What we don't see is the trust fund, the inheritance, the parental cosign on their apartment, or the $60,000 in student loans they're conveniently not mentioning. Comparison is the thief of compounding. Now let's get into the layers. Layer 1 is what I call the breathing room fund. I refuse to call it an emergency fund because that framing makes it sound like something bad you're preparing for. I want you to think of this differently. This is the money that buys you freedom. Freedom to say no. No to the payday lender when your car breaks down. No to selling your investments at a 30% loss because you need cash today.
No to staying in a job that's destroying your health because you literally cannot afford to quit. According to the Federal Reserve's 2023 report on household economic well-being, 37% of Americans cannot cover a $400 emergency without borrowing money. That means more than 1 in 3 adults are one flat tire away from a financial spiral. Your breathing room fund starts at $1,000. That covers most minor emergencies and gives you a psychological safety net that changes how you make decisions. Then you build it to 1 month of expenses. Then 3 months. If your income is unstable or you're a single-income household, push towards 6 months. This money goes into a high-yield savings account, not the stock market, not crypto. A boring, safe, accessible savings account earning 4 to 5% as of 2025. Here's a data point that might surprise you. Research published by Vanguard found that people with at least $2,000 in liquid savings scored 21% higher on financial well-being metrics than those without any savings. That was the single largest boost from any financial factor they measured, bigger than income level, bigger than investment returns. $2,000 in a savings account had more impact on how financially secure people felt than earning an extra $20,000 a year. That's not just math, that's psychology.
Layer 2 is killing the bleeding. Once your breathing room fund is established, it's time to hunt. Your target is every piece of high-interest debt you're carrying. I define high interest as anything above 7 to 8% annually. Credit card debt is the #1 villain. The average credit card interest rate in America right now exceeds 22%. Let me put that in perspective with real numbers. If you have $5,000 in credit card debt and make only minimum payments, you will pay nearly $2,800 in interest over 5 years. That's $2,800 that could have been compounding in your favor instead of funding someone else's profit margin. The strategy is straightforward. List every debt by interest rate, from highest to lowest. Pay the minimum on every account. Then throw every available dollar at the single highest interest debt until it's completely gone. Then roll that entire payment onto the next debt. This is the debt avalanche method, and it is mathematically the most efficient way to eliminate debt. Some people prefer the debt snowball method, paying the smallest balances first for psychological momentum. I don't hate that approach if it keeps you in the fight, but the avalanche will save you more money. The only exception to this layer is your employer's 401k match, which I'll cover in layer 3. But aside from that, you do not invest a single dollar in the market until the bleeding stops. You cannot fill a bucket that has holes in the bottom. Plug the holes first.
Layer 3 is capturing every free dollar available to you. If your employer offers a matching contribution on your retirement plan, you need to capture every single cent of that match, even while you're still paying off high-interest debt. I know that contradicts what I just said, but employer matching is a guaranteed 100% return on your money. Let me repeat that. 100%. Instant, guaranteed. No investment vehicle on the planet can promise you that. A typical employer might match 50 cents on every dollar you contribute, up to 6% of your salary. If you earn $60,000 a year, contributing $3,600 gets you an additional $1,800 from your employer. That's an immediate 50% return before your money even touches the stock market. Over a 30-year career, assuming a 7% average return, those matching contributions alone can grow to over $170,000. That's $170,000 of essentially free money that most people leave on the table because they didn't understand the order. The only thing to watch for is vesting schedules. Some companies require you to stay for 3 to 5 years before you fully own those matching funds. But even with vesting requirements, the math almost always favors contributing at least enough to get the full match.
Layer 4 is the layer that almost every financial influencer skips, and it's the one that matters most for actually building real wealth. I call it the income engine. Here's the uncomfortable truth nobody in the investing content space wants to talk about. The median American household income is approximately $80,000, according to the Bureau of Labor Statistics. If you invest 15% of that, you're putting away $12,000 per year. At an 8% average return over 20 years, that grows to about $590,000. That's not bad, but it's not financial freedom. It's not the kind of money that changes your family's trajectory for generations. The problem is, the capital base is too small. You're trying to fill a swimming pool with a garden hose. Layer 4 is about widening the hose. Before you go all in on the stock market, invest in your ability to earn more money. This means developing high-income skills like sales, data analysis, project management, software development, specialized trades, or consulting. According to research from Georgetown University's Center on Education and the Workforce, workers with in-demand skills earn 20 to 50% more over their lifetime than peers without them. That additional income, when deployed through the investment layers we're about to cover, compounds into something extraordinary. Let me show you what I mean.
If you can increase your household income from $80,000 to $110,000 by developing a marketable skill or starting a side income stream, and you maintain the same lifestyle, you now have an extra $30,000 per year flowing into your investment pipeline. At that same 8% return over 20 years, that produces nearly $1.5 million instead of $590,000. Same discipline, same timeline, more than double the wealth. The only difference was a wider income base feeding the machine. The financial industry doesn't talk about this because nobody can charge you a management fee for learning a new skill. But the highest return investment most people will ever make is in their own earning capacity. Layer 5 is the tax optimization zone. You've built your foundation, stopped the bleeding, captured free money, and widened your income pipeline. Now it's time to make the tax code work for you.
First, your individual retirement account, the IRA. For 2025, you can contribute up to $7,000 or $8,000 if you're 50 or older. The reason an IRA often comes before maxing out your 401k is control and cost. Most corporate 401k plans offer a limited menu of funds, with management fees ranging from 0.5% to 2% annually. Over 30 years, even a 1% fee difference can cost you hundreds of thousands of dollars in lost growth. With an IRA, you can invest in low-cost index funds, charging as little as 0.03%. The question everyone asks is traditional or Roth. Here's the simplified framework. If you're in a higher tax bracket now than you expect to be in retirement, go traditional. You get the tax deduction today and pay taxes later when you withdraw. If you're in a lower bracket now, which is true for most younger workers, go Roth. You pay taxes at today's lower rate, and everything grows and is withdrawn completely tax-free. If you're genuinely unsure, split contributions between both types for tax diversification. Next, and I cannot stress this enough, if you have access to a health savings account, this might be the most powerful investment vehicle in America that most people are completely ignoring. An HSA offers something no other account provides, a triple tax advantage. Tax deduction on contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. For 2025, you can contribute up to $4,300 individually or $8,500 for family coverage. Here's the advanced strategy most people miss. If you can afford to pay your current medical expenses out of pocket, do that and let your HSA money stay invested in the market. There's no time limit on when you can reimburse yourself. You could pay for a doctor visit today,
keep the receipt, and reimburse yourself from your HSA 20 years from now, completely tax-free. If you max out HSA contributions for 30 years at a 7% return, you could accumulate over $400,000 in completely tax-free money. Given that Fidelity estimates the average retiring couple will spend over $300,000 on healthcare in retirement, an HSA can essentially eliminate one of retirement's biggest financial risks. After your IRA and HSA, go back and max out your 401k beyond the employer match. The 2025 limit is $23,500 for most people. Between your IRA, HSA, and 401k, you could shelter over $35,000 annually from current taxation. That's serious money compounding year after year without the IRS taking its cut.
Layer 6 is where discipline becomes destiny. I call it the automated wealth machine. Once you've maximized your tax-advantaged accounts, open a taxable brokerage account and set up automatic monthly investments into low-cost, broad market index funds. The S&P 500 has delivered an average annual return of approximately 10% over the past century, according to data compiled by NYU Stern School of Business. After adjusting for inflation, that's roughly a 7% real return. The key to this layer is automation and consistency. Set up automatic transfers from your checking account to your brokerage on payday. You never see the money sitting there. You never have to make a decision about whether to invest this month. The system runs itself, whether you're on vacation, going through a stressful period, or just forget. And here's the critical discipline point. Do not try to time the market. Do not pick individual stocks unless you've dedicated serious hours to understanding valuations, financial statements, and competitive moats. Don't chase the latest hot sector or whatever meme stock is trending on social media this week. Buy the entire market through a low-cost index fund and let compound interest do what it does. Here's what the math looks like at this stage. If you're investing $2,000 per month across all your accounts at a 7% real return, in 10 years, you'll have approximately $345,000. In 15 years, $620,000. In 20 years, over $1 million. In 25 years, $1.6 million. And in 30 years, $2.4 million. Notice the curve. It barely moves in the early years, and then it rockets upward. That's compound interest. Your money earning money on the money it already earned. It's boring in the beginning and unstoppable at the end. Layer 7 is strategic leverage. And this is where most mainstream financial advice gets uncomfortable. But it's also where the wealthiest families build real generational wealth. Strategic leverage means using debt as a tool instead of a trap. The critical distinction is this: good debt buys assets that pay you every month. Bad debt buys things that cost you every month. The most accessible form of strategic leverage for most people is real estate. Putting 20% down on a rental property means you control 100% of an asset using mostly borrowed money. If the property generates rental income that covers the mortgage, taxes, insurance, and maintenance with cash left over, your tenant is paying down your debt while you capture the appreciation. According to the Federal Reserve's Survey of Consumer Finances, the median net worth of homeowners is approximately $255,000, compared to $6,300 for renters. That gap isn't just because homes appreciate. It's because a mortgage is a forced savings vehicle with leverage built in. But I need to be very clear about something. This layer comes after all the previous layers. Buying a rental property when you have no emergency fund, high interest debt, and no retirement savings is not strategic leverage. That's gambling with borrowed money. The foundation has to be solid first. Otherwise, one bad tenant or one unexpected repair bill sends your entire financial structure collapsing.
Layer 8 is the destination, and it's not really a step at all. I call it the compounding flywheel. When you've built all 7 previous layers correctly, something remarkable starts happening. Your money begins generating money faster than you can actively deploy it. Your breathing room fund protects your investments from forced selling during emergencies. Your debt freedom means every dollar you earn is working for you instead of against you.
Your tax-advantaged accounts are growing without government interference every year. Your wider income base is flooding your investment pipeline with fresh capital. Your automated investments are compounding in the background every single day. And your leveraged assets are generating additional cash flow on top of everything else. This is the flywheel. Each layer reinforces every other layer. The emergency fund prevents you from raiding the investment accounts. The debt freedom prevents interest from eating your returns. The tax optimization prevents the government from slowing your compounding. The income engine ensures fresh capital keeps flowing in. And the leverage multiplies your exposure to appreciating assets. Here's what makes this framework different from everything else you've heard. It's not about how much you earn. It's about the order in which you deploy what you earn. A family earning $95,000 who follows this exact sequence will dramatically outperform a family earning $150,000 who skips layers. Because the family that skips steps keeps getting knocked back to square one every time life throws a curveball. A job loss, a medical emergency, a broken furnace, a car that needs replacing. Without the foundation layers in place, every setback resets the clock and erases years of progress.
I want to close with something that might be frustrating. You might be sitting there thinking, Guru, this is going to take years. I want to start investing now. I want to see my portfolio grow now. I want the green numbers on my screen. And I completely understand that impulse. But here's the truth that nobody making financial content wants to tell you because it doesn't get clicks. Building real wealth is not exciting. It's not a highlight reel. It's not a montage. It's boring, consistent, sequential action repeated over years and decades. The families who build genuine financial security are almost never the ones who found the next Amazon or timed the market perfectly. They're the ones who eliminated their debt in the right order, automated their investments into the right accounts, and then had the patience to let time do what time does. There's a famous finding from a Fidelity Investments internal study that looked at which investor accounts performed the best over a multi-decade period. Do you know who the top performers were? Accounts belonging to people who had forgotten they had accounts. And in some cases, accounts belonging to people who had died. Dead investors outperformed the living because they never panicked during crashes, never tried to time the market, and never deviated from their plan. You don't need to die to replicate that strategy. You just need a system, a sequence, and the discipline to follow it, layer by layer.
8 layers, 1 sequence. That's how real wealth is built. Not through hot stock picks, not through crypto moonshots, not through timing the market. One foundation at a time, in the right order, for long enough to let the math work in your favor. You don't need to earn more to start. You just need to start in the right place. And now you know that place. If this video changed how you think about money, watch this one next, where I break down the 2-income trap quietly draining dual-income households across America. A Harvard professor studied over 2,000 families, and the findings will genuinely change how you think about earning and spending. I'll see you over there.